It's been over a decade since the financial markets crisis of 2008, and yet here we stand today, still waiting for the full effects of that crisis to work through the system. This, of course, has a lot to do with the emergency central bank and government response to the crisis, an unprecedented injection of monetary policy and fiscal stimulus designed to not only stabilize financial markets, but incentivize investment with the goal of fueling stocks to the record high levels we currently sit just off. In recent years, the Fed has begun to reverse the experiment, finally recognizing we've reached a point in which the economic data has responded, and the greater risk now lies with maintaining this emergency level of accommodation. Still, given how low rates have been, the adjustment thus far has had no major impact on risk assets, with rates still attractively low for investors. But despite various economic indicators responding positively to all of the stimulus, there are still plenty of vulnerabilities in the local and global economy that are keeping the Fed from being able to get too aggressive with the normalization process. We saw this play out into 2019 when the Fed did a U-turn on policy that had been geared up for more rate hikes looking out, signaling a move back the other way, deferring once again to the accommodative side and bending to the will of investors. The other week, the Fed chair summed it up in a speech to the Stanford Institute of Economic Policy Research. Powell said the committee has adopted a patient wait-and-see approach to considering any alteration in the stance of policy. And so naturally, this adjustment to policy back to the dovish side has once again fueled the stock market while taking some of the wind out of the sails of the dollar. The Fed has cited Brexit uncertainty, trade tensions, and slowing growth abroad as some of the major factors driving the policy adjustment, and today we will get an update on all of this. Breaking it down, since January, there isn't much at all that's changed to suggest the Fed will be wanting to rock the boat more than it already has in the aftermath of this latest bout of misguidance heading into 2019. Economic data that has been expected to benefit from Fed accommodation has kept with the same direction, but at the same time, those other cited downside risks should keep the Fed from issuing anything that shifts back to a more hawkish-leaning message. In fact, the market is now pricing greater chances for the next rate adjustment, whenever it does finally come, to actually be an adjustment lower, not higher. But at this stage, we see no reason for the Fed to want to be signaling a rate cut and would simply expect the Fed to address its U-turn on policy in the dot plot, showing a move from 2 rate hikes in 2019 down to just 1. The dot plot is losing credibility anyway with all the adjustments that we've seen, and is much less relevant when rates are no longer expected to be moving up at a gradual clip. The Fed chair addressed this issue at the Stanford Institute as well, saying he had asked the communications subcommittee of the FOMC to explore ways in which they could more effectively communicate about the role of rate projections. As far as the monetary policy statement goes, we expect the Fed will want to be keeping with the same outlook it put forward in January, which was one of patience. With inflation still below the 2% objective, it gives the Fed the flexibility to be more patient right now, though there are some Fed officials that are worried about holding off too long on additional rate hikes with the risk of falling behind inflation when it finally does come round. The other point of focus will be any updates we get on balance sheet adjustments, though again, we would be surprised if the Fed would be wanting to make any waves right now after the January turnaround. Looking at the FX market, one of the interesting things about all of this is that even with the Fed's reversal, the dollar hasn't really fallen off all that much. A lot of this has had to do with the fact that central banks abroad haven't been looking to be raising rates anytime soon while downgrading their growth forecasts. The ECB is the one that really stands out here, and this has kept the most actively traded market, euro-dollar, from popping up on the Fed U-turn. And so we have yet to see the buck sell off much despite the dollar bearish yield differential implications from the Fed's tinkering. But now that Brexit risk is looking less intense, and considering the U.S. administration is still well capable of enforcing a soft dollar policy, it will be interesting to see if this more dovish Fed will start to have a more U.S. dollar negative impact. As far as levels go, and using euro-dollar as a proxy, we would keep an eye on the yearly high at 115.70 and the yearly low around 111.75. Back above 115.70 would suggest that all of this dovishness is finally having a negative impact on the US dollar, while below 111.75, or while just maintaining current levels below 115.70, ultimately keeps the trend in the US dollar's favor. And that's all for now.